see. I'm gonna bump up Anthony. I thought Anthony could co-host this because of Metco. I thought you guys have a little bit of similarities, and then there'll
For
be
sure.
more questions.
Hey, Anthony.
Hey guys, sorry, it cut off when I switched over to the panel side. What were you saying there, Dennis?
No, I figured you'd be good to have on for these webinars. You usually don't jump in.
Oh, yeah. Matt, how are you doing?
Doing pretty well. How about you?
I'm well, doing good.
It's funny that you mentioned that. I don't know if you heard the interview I gave with Josh McCallan recently, but
You're kidding.
I pointed out Medco Share as an example of something that fits a startup model but still has a brick and mortar component. And so it's appropriate that
When
you'd be
did you
here.
see him?
No, I did a episode of Capital Hacking
Make sure
about
you lock my door. 1 second.
Oh,
I haven't seen him in person in a while, but
okay, because I actually had spoken to him in, I think it was sometime mid-December when we
okay.
met up at a holiday party.
Oh, there you go.
So we did have to follow up on a few things too. No, that's funny you mentioned that.
Yeah.
So I'll
It
give
is
it
a small
another
world.
minute. I don't know. Ryan is the other person that's on the call. Ryan, if you want to jump in, just throw in chat and I'll throw you on and we could do more of a meeting format. Um, but we'll see. Up to you on how it goes. So Matt, I usually record this. You know how it is. I send it out to the
Mhm.
VA. She usually cuts it up. I was a little skeptical about this time. This is like no man's sign for usually with webinars because people are still either coming home from work or whatever it is. So whatever we get, we'll throw it on the webinar. Either way is good for me. I'll have Ryan jump on. So this is a small world. Let me see. As long as the group stays small, I don't mind getting more people on. Anthony, Ryan is the person with the Tampa Bay deal. So small world.
Okay.
Ryan, I met actually through Richard
Right.
Fowler. Ryan was also a DeRosa investor. He was in Matt did a mastermind for a little while, and Ryan and Richard were in the same group. And Richard was like, "You should connect with Ryan. He's out in Jersey." Turns out me and Ryan are from Staten Island together, and I think we played basketball against each other like decades ago. Ryan ended up investing in Bradley Beach. When me and Brett and Fabio did the wholesaling thing, we partnered loosely on Ryan on a couple of things. But basically, Ryan has that Tampa Bay property that I sent you. The income fund might be investing in Ryan's project. And I think it goes with the whole concept of constantly doing business with the same group of people so everybody grows. So I'm actually happy that this turned out to be the group on this call. Ryan, have you ever met Matt at all?
I
Okay.
don't believe so. Name looks
No.
familiar, but I don't believe we met.
So
I
you
was
guys,
thinking the same thing. You look familiar for some reason, but I don't know. Smallish worlds.
you guys both are Bradley Beach investors.
That's true.
That's one thing. Ryan, I met Matt 5 years ago at the Renault thing that Faircloth sent me to. And then we've been doing a lot of the investments together ever since. So again, small world. It's like a 1 degree difference with everybody. So Matt, I'll let you get started. I'll throw you in since it's a small group. Ryan, Anthony, if you guys have questions, I know Anthony, you're looking to potentially invest in Noplex. So if you have any questions, just shoot it out. We could go into more detail. Look, even if we don't get any good social media out of this, it doesn't really matter. It should be a good hour. You ready, Matt?
I'm ready to go.
Go for it.
Sure. All right. First off, thanks for having me. I'm excited. I always love sharing insights with people that they might be able to take back and use to massage their investing strategy in their portfolios. I'm going to talk a bit today about investing in startups, which I realize can be daunting to some people. It can seem a bit complex, and that's not unfair. It is often daunting and complex, but I think that you could say that more for people that are starting from the beginning. And with a group like this, I think having a sound foundation of a lot of investing principles lets you translate and skip to the front of the line. So I'm going to share my screen. Let me see here.
You should be co-host, so you should be good to go.
Host disabled participant screen sharing.
Oh, you are disabled? Give me 1 second.
I think that's just an unfortunate default.
All right, you should be good.
There we go. That's me. All right. Let's see. How's that look? See it?
Good.
All right, cool. All right, so To begin, a couple assumptions. One, I'm going to assume that the people watching this are going to most likely not be very seasoned startup investors. If you are and you're watching this, stick with me. We'll get through the fundamentals and then we'll talk about things that I think you'll find valuable. I'm also going to make the assumption, given the fact that this is an SIH Capital webinar, that you are familiar with the structure of things like real estate syndications and how they typically play out and what their life cycle looks like. Because I'm going to draw some comparisons there and look at startups through the lens of someone who is familiar with that. I hope those assumptions are true. And from there, let's talk about what a startup is. When you hear startup, you typically most likely think of technology. You most likely think of software, which is relatively safe. That constitutes a lot of the startup world and the types of models that people are referring to when they talk about startups did certainly originate in tech and software. But for the purposes of this, and it's awesome that Anthony's on, because I think that MedcoShare is a really good example of what I'm about to say. But I think that pure technology and pure software with no sort of brick and mortar component, with no sort of physical tangible asset component, is a subset of the totality of startups, right? So I'm going to define, for the sake of this, startup as a relatively new company that is focused on innovation in some way, right? As in iterative, incremental innovation on concepts that already exist in a market, as in disruptive innovation in the sense of something completely new that hasn't really been done before, as opposed to, replicating something that has been done before almost exactly, because for other reasons, that doesn't tend to be as appealing to capital partners. So one, relatively new. Two, focused on innovation. And three, it follows a specific economic structure or set of economic structures, which we'll talk about in detail. With that, let's start by looking at an operator's view of a real estate syndication so we could set the stage for some comparison. I'm going to vastly oversimplify this, but we're going to talk about what it actually looks like from 100,000 feet up to follow a syndication entire life cycle from idea through exit. First, you research the domain, you research the problem space, you understand whether or not there's a need and whether or not your solution is the solution for that need. This area, an area that could use another multifamily residential, is this area with giant houses with giant basements and giant attics and garages a good opportunity for public storage? Basically taking a step back with some objectivity and understanding what problem you're trying to solve and whether or not your solution is the right solution for that. Secondly, you research the competition, especially with something like real estate. Competition isn't necessarily a bad thing. It could just be validating the market need, but you want to make sure you understand it really well. Three, you develop a business plan, you develop a pro forma, you start building something that you can shop to prospective investors. You raise capital, you purchase, you build, you value add, and you reassess. You take a look at your assumptions that you had made early on in the process as you were considering the opportunity. And then from there, you basically loop through this. And again, this is oversimplified, but if you really take a step back, this is the script. So you reassess, you build, you grow, you reassess, you build, you grow, you reassess until an exit. The thing is, we're pretty used to, I'm going to assume that people on this call, how capital is generally raised for a real estate syndication. In a lot of cases, you're looking at a relatively templated concept and expectations around a private placement memorandum with a preferred return and certain terms and expectations around a liquidity event in the future. I think most of us are used to that. And I think understanding that concept is really valuable for understanding some of the more quote unquote daunting parts of innovation investments for people who are not used to them. Let's take the same exact view and look at it from the perspective of a startup's founder. Again, from idea through exit, full life cycle. So same thing, research the domain and the problem space, right? It's really no different. You need to understand if there's a problem to solve, what the size of that problem is, what the product market fit is. You research the competition, which is very different because you might be running into things more closely related to intangible intellectual property relating to startups that might not necessarily be as much of an issue outside of branding with real estate. One thing that startups will typically do, and I like to see in a startup that I'm considering investing in, is developing a proof of concept. And this is really hard with real estate because of the nature of the asset class as well as the scale. But in a lot of cases with startups, there's the opportunity to build an ugly, loose proof of concept, get it in front of people, test it out, see if there's value, see if there's traction, and basically not only prove the potential value, but also understand exactly how it's being received and how feedback can affect what the final version of the product ends up being. Same thing, you develop a business plan. Typically, it's not a PM. In a case like this, you're going to have that ready to go, but usually a lot of the primary pitch is in a separate pitch deck, which is usually much more concise. And then you have supporting materials. Raise capital, build, grow, reassess, repeat. Now, one thing that you do see with real estate syndications, but is considerably more common and expected with startups, especially pure technology startups that have the ability to scale to global populations, is that loop goes back a little bit. So you would continue to raise capital. You usually hear about series capital. So we could talk very briefly about that. Generally, when a company is just starting, they will raise what's called a pre-seed round, meaning that it's typically friends and family. If you're lucky enough to have a network that has capital there, it is typically composed of angel investors, individuals who perhaps have had a tech exit in the past, understand what that life cycle and risk looks like, understand what it takes to assess the capability of a founding team and whatnot. And then the one thing to keep in mind too is a lot of the same rules apply to real estate syndications as to startups in the sense of accreditation criteria and whatnot. Nothing really too different there. And then eventually exit. Now, this is the part that is, I think, particularly interesting to people who like to go a little deeper, but the way that capital is raised is very different. Typically starts with a pre-seed round. In a lot of cases, that's under $1 million for a couple of reasons. One is tax advantage. Two is the fact that a lot of the platforms that handle equity management will only begin charging fees at about $1 million of a raise. A bunch of reasons like that. Basically, what you want to get out of a seed round, at least in my view, is far beyond proof of concept, an actual working MVP, minimum viable product, and an understanding in quantitative terms of what unit economics look like in a way where I could reliably say if I'm going to crank up, for instance, ad spend, what that chart is going to look like for recurring revenue or revenue. So it's about coming to a place where at the end of pre-seed round exhaustion, typically you're going to want to see someone have a very solid tested plan and the ability to scale. A lot of startups will typically try ambitiously to stop raising capital there and subsist off of actual revenue. But when that doesn't happen, you'll typically see a seed round, which is a second round. It's usually a little larger. This is the part where more likely you're going to get interest from institutional capital sources, such as venture capital funds and things like that. And you won't have to rely so much on high net worth angels and friends and family. And then beyond that, as things grow, as you see traction, as things are proven out, you then get into what's almost always institutional capital for Series A, Series B, Series C. And these are essentially rounds where in exchange for cash infusion, equity in the company is given up. The vehicle through which a lot of this typically happens nowadays, especially for very early stage startups, especially when you're dealing with angels and friends and family, but even to a pretty major degree these days, venture capital firms is what's called a SAFE, a simple exchange for future equity, or a simple agreement, excuse me, for future equity. And that is the equivalent in some ways to how syndications are typically funded. I am the founder and CEO of a relatively early stage startup right now. So we have the benefit of actually going through a case study. So this is the top of a SAFE. And what a SAFE is, it's a simple agreement for future equity, quite literally. What a SAFE does is it defers the valuation of the company until a later date when it's considerably less ambiguous. And I'll talk about that. But basically, for a long time, there were quite a few different types of vehicles for investing in early stage startups. A while back, a company called Y Combinator devised the SAFE, and it's since become, in many ways, the standard to a degree that I will say that I don't believe I've ever invested in a startup that did not come by way of a SAFE. And honestly, I think, especially for people doing a lot of deal flow, that would be a turnoff to see something that is not a SAFE at this point, just because people who have done it many times could almost recite how a SAFE term looks. So a SAFE will typically have several things. It will have a valuation cap, the purchase amount, obviously, the amount that's being invested, and then a discount rate, right? Or a discount. Going back, a valuation cap is an amount of money, and I'm going to explain this in a, again, overly simplified way, but I think we'll get the point across. A valuation cap is an amount of, it's a valuation of the company that you are using to, as the ratio of equity that will be given relative to the purchase amount. That sounds confusing. Let me put that through an example. So this is a $10 million valuation cap, right? And let's say the purchase amount, just for the sake of rounder numbers, is 100,000. That is basically saying that for $100,000, you would receive 1% of a company at a $10 million valuation, right? That is not entirely true. When I say I'm oversimplifying, I am oversimplifying because there's common shares, there's preferred shares. Typically, these are preferred shares. There are certain things that will dilute equity over time. But all said and done, for the sake of simplicity, you're basically saying that I'm committing to providing this capital in exchange for a set percent of the company's equity, right? And then whatever, so once later down the line, when the company has some traction, something called a 409A will take place, which is an independent third-party valuation that's incredibly thorough. And upon a point like that, suddenly the promise of equity turns into true equity at the ratio that you agreed upon in the SAFE, regardless of the value of the company. For instance, if you agree to 1% of the company for $100,000, and then the company is worth $30 million, suddenly that's essentially a 3x, right? And so on and so forth. That's the general idea of how that works. And we'll go into why that's actually meaningful in a moment. A discount is essentially an insurance policy against lukewarm growth and development. And so I think a way to look at that is basically to say, if the company's valuation at the time of a 409A is at or below that 10 million valuation cap, you're still getting a piece of ownership that is discounted by 15%. So basically you're getting it under the valuation cap that you agreed upon, right? So what does it all mean? Like, where is this valuation cap coming from, right? Now, this is where I think things begin. This is where the value of really understanding this stuff comes in, because the literacy around this is going to make or break your ability to turn this, what you see here, into a tangible projection. So to get into that, the first question is, should real estate focused investors invest in startups? And I think the answer is maybe yes, if you can reduce risk enough. And so here's what I mean by that. some people will say that you shouldn't get involved with startups unless it is something that you're passionate about, something that you understand, something that you believe in, something where you have a very clear understanding of the ins and outs of the industry. I don't personally believe that's true. I think that that startups can provide an important part of someone's overall portfolio and risk profile. Because if you think about it, if you have Coca-Cola and index funds on one end and a roulette wheel on the other end in Vegas, the 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 distance toward roulette that startups exist in is a little closer than I think many investors are comfortable with. And the reason for that isn't unfounded because at the end of the day, statistically, most startups and most new companies fail to the point that if you look at the allocation for large venture capital funds over the last couple of years, they're typically investing in hundreds and hundreds of companies every year. Many of them go nowhere, but the wins are winny enough that it makes up for a lot of the losses. Now, I'm going to assume all of us are not in a position to invest in hundreds of companies in a given year. So that's where the risk starts to add up. The truth is, if you shut your eyes and throw a dart at a dartboard and you hit a startup, that startup is going to statistically fail. So how do we tip the scale in our favor? So if we look at the startup from the investor view, I'm going to talk about the things that I think are really important to understand while assessing the validity and the potential of a startup, and then actually go through some examples. From opportunity through return, I would just say look at it like that risk is directly proportional to uncertainty. The more you decrease uncertainty, the more you decrease risk. Do I like this idea? Yes. Do I think this is something I believe in? Yes. Where's the uncertainty? The uncertainty is going to be in the approach and the plan. First thing, understand innovation investments and risk in general, right? That's what we're talking about today. This is understanding what it looks like, understanding what types of vehicles are used, typically convertible vehicles for investing. Research the domain and problem space. If it's something that, even if it's something you're passionate about, really understand it. Understand implications across the board, legality, regulation, and compliance. Understand the size of the market, understand peripheral markets, understand what other market forces could affect the validity and lifeline of an idea over time. Research competition, really research competition, because like I said, a lot of companies will defer some of this early on because of costs, but stepping on IP could really cripple a company for a while. And so it's important to understand the competition, understand the opportunity terms and the ROI projections, look at the safe, understand the safe, and then check the safe against what they're actually projecting and what seems realistic. Again, we'll get into details here. Invest or do not invest in the leadership team. When I say most startups fail, keep in mind, a lot of those startups are a 22-year-old kid who came out of Stanford. This is what I do, right? I come out of Stanford and I start a company. And then down the line, suddenly you have 65 employees and you have absolutely no idea what to do. You don't really have the leadership skills, right? You don't need a leadership degree to get an idea license. I think there's a lot of times when it's not a matter of a bad idea, but a matter of mismanagement and poor financial decisions early on, especially when something is in its very early stage. In a lot of cases, you're investing in your perception of the capabilities of the leadership team as opposed to anything relating to the actual execution at that point. Understand in detail their strategy to go to market, right? That can vary drastically depending on the nature of the business and the product. But whatever it is, you should understand what their plan is and not accept ambiguity there. And then what I'm going to do real quick is I'm going to go through some slides.
Matt, before you move on, just let me know when you're about to go to the next thing, because I want to throw something at you.
Throw something at me. I was going to go to a pitch deck and start to walk through some of the things that I think people need to scrutinize.
So I want to tie this into real estate investing a little bit, because a lot of people love the idea of real estate investing is because social media, right, and certain marketing gurus explain how easy it is and how passive it is to invest in commercial real estate, right? So once you wire the money, then yeah, it's truly passive, but there is this active passive approach before that, right? Where in how you say understanding innovation investment life cycle, we could say in real estate world, it's understanding the asset class itself in commercial real estate, whether it's apartment buildings or mobile home parks, etc. Research domains, problem space, all of these can be attributable also to real estate investing. And
Exactly.
part of that is, hey, do you know anything about underwriting? Because I talk to a lot of passive investors and they never go that step. They never learn the basics of underwriting, even though it'll make them a 10 times better investor. Because part of it is the whole misconception of being passive. So in a situation like this, I would say if I didn't, so all my startup investing, full transparency goes through you, right? I usually anything startup related, Matt, can you do this? Because I don't have the time to learn these 8 steps because I'm focused on my real estate business, right? So, what do you recommend someone who likes the idea of diversifying into startups, but feels like when you get a list this big, as that's so daunting that they're not even gonna get into the world of actually investing because that is a big list. And I personally don't want to learn that list. How do you navigate? What would you tell that investor? Is there other Matt Cannings out there? What's a little bit of a shortcut, or what is the solution to potentially learning all these 8 steps yourself?
That's a great question. I would make the case that much like real estate, the amount of diligence that you put in is going to reduce the uncertainty more and more. And you can, if there's a direct relationship between risk and uncertainty, then you need to bring uncertainty down to a point where you can tolerate the risk. And that's a personal thing, right? For instance, if you're just a completely passive limited partner in a real estate syndication, if somebody who has a really great track record and I've worked with in the past and is just killing it shows up and says, hey, I have this deal, you could say, awesome, I'm in. So that's on one end. That's just completely trusting in an operator. On the other hand, you could sit down and do everything that I said here. That's on the other end of the spectrum. What I'm recommending, and I appreciate you calling this out because the point I'm trying to make is actually more along the lines of this is a cheat sheet, not for what you should necessarily know deeply as an investor, but rather what you should expect the leadership team of the startup to know offhand, have available to you, etc. Because to me, that is you ever hear the story of who was it? Van Halen requiring a bowl of green M&Ms, right? There's this whole story of backstage, they wanted green M&Ms. The real story behind that is they did that so that they could assess how diligent the team was because there's pyrotechnics involved. And they're thinking to themselves, if they can't follow that direction, they might not have followed the directions for something that's going to singe my chest hair off if I'm David Lee Roth, right? And so I think there's an element here where I'm not saying that you should yourself really understand the go-to-market strategy that's ideal for a company that you'd be investing in, but there are many times when a startup's founding team cannot produce all of this to a level that I think would be enough to reduce uncertainty reasonably. Does that make sense?
It does, but here's again,
if I can't answer these things, you shouldn't invest with me.
Here's the devil's advocate, right? If I don't fully understand these, I also don't have the ability to fully evaluate the answers. And then your job as someone who's selling the startup is to make it look nice. And just like in the real estate world, right? How many syndications do you see that have 20 plus IRR returns that never ever see a 20 plus IRR return? If anything, you're lucky to get your capital back because those people underwrote so aggressively. It's how does someone who's just getting into the space even understand the answers that are given to them? It's great that they know the cheat sheet of what questions to ask them, but how do they, to me, the answer is networking and figuring out that component of it. I need to find someone like you that can, even if I have to pay a consulting hour, that's going to be a lot cheaper than paying $10,000 to $50,000 investor. Like, what resources are there out there to meet someone that can help you answer the questions. I'm just pushing back a little bit because
Yeah.
I know for a fact if someone's raising money and I ask them these questions, they're going to make the answers look really good. But that means it won't produce any meaningful value.
So yes and no. So to answer your second question first, I'm sure you could just do a search and find some people that specialize in helping with this. But much like I'm sure you agree, it's more about building your own network and building trust with the people around you that are equipped to do this. But you answered your own question earlier about if you were to scrutinize a startup on these criteria, they're going to give you a shiny answer that you don't know any better than to solve. But that's where I disagree with you, because I think that everything from your nose for bullshit through your financial acumen from real estate is going to give you what you need to do this relatively well. If I show up and I'm offering some sort of strange convertible vehicle that you've never heard of, a red flag, right? If I am building a search engine first off, I don't have competition assessments in my slides are available to you, or I do, and I don't talk about Google, right? Then, right, you're going to say, okay, this is an incomplete risk assessment, or this is a risk assessment that doesn't entirely work. The opportunity terms and the ROI, same type of thing, right? It's Excel math. If you walk away and with a napkin, you can't understand what different annual recurring revenue would look like for a valuation, and then what a valuation would look like for your investment, then that's stuff you have to have them help you understand. Go to market strategy. If somebody says, and there was such a rich venture capital market a couple of years back that you would get people who are like, listen, this is a great idea. I'm going to build it. I have no idea how it's going to make money. I have no idea how I'm going to get it out into the market. I don't know what marketing spend is going to look like for this, but like the idea is great and we got good people on it. That doesn't gel, right? That's like saying you're buying a plot of land and you have this awesome idea for this building. Trust me and invest, right? I think there needs to be a much more tangible plan. So I would say that and that's part of why I'm here talking with this group, is I would make the case that your experience in real estate equips you to know what types of things to ask and what types of things to expect from the type of team that is likely going to execute.
Yeah, Dennis, if I could jump in, and it's a big risk reward kind of thing when you're talking about startups. There is some due diligence that has to be done by the investor. And if they don't fully understand, then they should keep asking questions until they do. Otherwise, don't invest in something you don't understand, like Warren Buffett always said. I think with the startups, and just like real estate, people are investing with people in the end. And Matt's calling it out here to the leadership team. That's the most important part. And we all know people who have great ideas, but can they get it to the finish line? Do they have the people to execute it? So it's not just a matter of knowing your numbers and everything. It's also being able to analyze people to see, is this a pedigree that can take this to the finish line to get it to where it needs to be?
Agreed. Yeah. And I will say that I may be on the more extreme side in what I expect to be able to see from a startup. And I know people that have invested successfully with companies that had far less, I'll say, informational maturity early on. And that happens. There's a success there. But again, risk is relative to uncertainty. And the more certain you are, not necessarily in the specific due diligence here, but the more certain you are that the people building this thing have thought of that, have looked into that, understand that, know how to do that, have done that in the past. To me, that's when you crank down uncertainty to the point where your personal risk line exists.
Yeah, if you call out, say, 5 things that they haven't looked into, then that should be your red flag that this is not the right thing to invest in if they haven't looked into this already.
100%. Yeah. And it's also as a founder, and Anthony, you probably experienced this as well. there's something like you get a little dopamine hit when people ask you what they think is going to be a really pressing question. And you're like, here you go. Here's 6 pages on it.
Yeah.
Let me
Yeah.
know if you have any questions. That builds trust in your ability to execute over time.
You and Anthony made some great points, and I think this also alludes to the problems of today. We have some prominent crowdfunding sites that do startups, and the problem is, it's if you are newer, they are going to make it look like it's really easy to invest in these startups, but then there's no connection to the leadership team, right? Because everything is monitored through the thing. So it's just something I think I want to point out. Be careful when you go through those channels and you don't have any contact with the leadership team, because then you're just over relying on the medium that crowdfunding site. And a lot of times those guys are tech guys and they're not actual investment professionals. And I've been victim to this when I started investing, and I was an early investor in realty shares. And those are the guys who were professionals and they knew absolutely nothing about real estate at the end of the day. So just be careful about that when you're dealing with even the startup spaces. There's no real shortcuts. It's either you really know the leadership team or you don't.
You're very big on relationship-based investing, right? And keeping the circle close. And you've really driven that point home over the time that I've known you, and I admire that. Do you believe that there's any place for investing in things that you are not personally connected to? And I don't mean as far as concept, as far as, for instance, access to the leadership team and things like that.
I just think, genuinely speaking, I've always gotten way better results when there is that relationship connection. And,
Yeah.
and whenever there wasn't, there was just really unacceptable answers to long delays. We were part of a Ponzi scheme, right? And I think that was a perfect that was a perfect example of us not having any relationship with the operator. And it's like, what's the point? There's so many deals out there that you can get that. If you think of it as the 6 degrees of separation, I think the
Yeah.
closer you could get to the operational team and cutting out the degrees, the more information you'll have. Because this is the biggest advantage of private securities over public, is that there is no such thing as insider trading, right? You have the ability to become best friends with that operator, and there's no better inside information than that. So
Sure.
I'm not saying that every investment you need to make, you need to be best friends with that person, but I do think that there needs to be as close. I think people will see, and I always tell this to people, put a chart down on their investments. And I say this in the real estate world too. Put a Excel chart together and put 1 to 10, label what you've invested with, who you've invested with, and what is your relationship with them from a 1 to 10. And then put in reputation and put 1 to 10. And there's some people that are just such good reputations that I get it. They raise at a blink of a dime, blah, blah, blah. But it's scary to put that down in a chart to realize how much of your investments are going by strictly reputation and how much of it's going by true tested relationships with that team.
Agreed. I'll actually just bring this up real quick. Can you see this as well?
Yeah.
So I won't go through whatever 30 some odd slides, but I'll say that this is the deck that I offer as supplemental material whenever I'm speaking with a prospective investor. It goes from everything from the showing the intentionality of what I'm doing, what they can expect access to as an investor, real-time dashboards with everything critical, a deep competition analysis that goes a bit peripheral from the specific type of, in my case, application ecosystem, actual discussion about exit paths, prioritized segmentation strategy, how we're going to market, financial exercise, where all my numbers come from, projections to profitability, the details of the offer, risk analysis, both existential and specific. Existential in the sense of what is preventing, what type of thing could occur that would make this entire technology class obsolete, all the way down to specific players in peripheral spaces being able to replicate what you do. And then basically just a lot of research and sources and citations that are the foundation of a lot of the stuff in my primary deck and things like that, and like where the actual numbers are and everything. I always want to be able to cite my sources, but this is the type of analysis and scrutiny that I perhaps unfairly expect, but I think seeing this type of thing and being able to, again, look at it as just an investor will get you pretty far.
Matt, do you have a bio slide that you could go through? Because I don't think you jumped in. What makes you someone that people would want to reach out to as, let's say, a startup consultant or something like that? What's your background here? Like, how did you come up with all this? Did you go to school for this? Can you give us a little bit of your background? Because I don't know if you jumped into that when you started.
Yeah, I invented the automobile. So I'm just basically living off that. No, I would say that the one thing that has become a differentiator for me is the fact that I have been on all sides of this. So I have worked as an executive at Fortune 50 companies. I have led part of wholly owned subsidiaries of Fortune 50 companies. So basically playing startup with corporate capital. I have been on the senior executive team at Series B funded companies, $1 billion valuation, 500-person teams, few years old, leading strategy there. I have been an advisor to early stage startups. I have invested in multiple early stage startups. My initial background is in software development. And so I have an ability, I think, to assess the capabilities and potential of a leadership team from angles that not everyone can, right? I can assess them as leaders because I've had, VPs reporting up to me, and I understand what it takes to lead on a strategic level as well as a tactical level. But I also know I can assess the tech stack of a company. And if someone is leading a company and they haven't really done so at scale, I'm going to be able to sniff out with a few questions whether or not they're thinking about for instance, unit economics of what they're doing infrastructurally at a large scale, dealing with, for instance, cloud expenses or things like that. So I think I have the perspective from so many different angles that it puts me in a position to assess, and going back to my own point, to reduce uncertainty to a degree that I can reduce risk.
Got it. Do you want to go over a case study? Do you want to do Noplex or do you want to do Lula, the other invest? Oh, actually, for that, I want to go over a simple question. So you come from the tech world and you've gravitated towards real estate because I think you sense the risk reward benefit, and something I talk about in my books. One of the reasons why I like the startup angle once I got to know you was the fact that my real estate projects can't 10x. But my real estate projects have an extremely high probability of success. So I would rather take my 2x at a 90% success rate. But then to get ultimate diversification, there's that long tail model that real startups provide, because you could get a 10x, 20x, 30x, 50x, whatever it is. And yes, your success rate might only be 10%. But when you diversify from a 90% success rate with a 2x multiple, with a 10% success rate or a 5% success rate with a 20x, the combined portfolio becomes a better product, right? A greater potential return. As someone coming from the tech world that stumbled into the real estate world, what does your ideal portfolio look like between real estate and tech startups? And then what do you think someone who does, and this is not financial guidance or advice, this is more about, hey, what do you do personally? This is not you giving any financial advice, just portfolio allocations between the two asset classes.
Yeah, that's a great question. So I would make the case that it's a deeply personal thing, because you might be at a different stage of your life where that affects your risk tolerance and informs your risk tolerance. You may have needs and people who rely on you in a way where it becomes much more difficult to take bigger risks. I'm personally a fan. One of the reasons I really enjoy being an LP in syndication deals is, again, going back to uncertainty and risk. I understand how to read them. I understand how to assess an operator and their history well enough where I feel like I can typically understand if I can reduce the uncertainty enough to reduce the risk. To me, I'll say flat out that the vast majority of my illiquid wealth is in real estate backed assets. That goes for individual deals. It also, I have a good amount of money in funds as well, large national funds. I am invested in startups. I'm also invested in cryptocurrency. Those are things that to me are much higher risk, much higher reward. At the risk of sounding hyperbole, I know very few people who invested. I know very few intelligent, experienced, networked people who invested in something real estate backed and that went to absolute zero. But I also, the people in my phone who invested very early on in a company that ended up worth $1 billion with a B, those, you don't see that in real estate. And so that's why I think, to put it more succinctly, I think that you should be intelligent about investing more heavily in lower risk things. But I do think that there is a place, and an important place, in higher risk things. And that's also it's a muscle you develop over time. Whether something ends up relatively lukewarm or something that you regret, at the end of the day, with things like that are higher risk, you learn, right? And then you can do better next time as long as you don't give up.
Yeah. Matt, if I could mention just from, I
Please.
guess we had a lot of real estate investors also coming from the MedcoShare side when we started up, and a lot of them would be asking, like, what are my returns? And it's a
Right.
startup, you're not getting returns, right? It's
Right.
basically the value, like you pointed out, it's 10x and it's 20x and it's 100xing. It's a huge difference with what you can do versus real estate, but you don't have that continuous cash flow, monthly cash flow. So for the real estate point of view, that's the big difference. But besides waiting for that company to go IPO, there are places when you get to, say, another round of funding, a Series A or a Series E or whatever, that there's websites now where people can sell those shares if they want to cash out early before, say, an IPO or something happens. So that gives them a little bit more options for liquidity if they don't want to wait, say, 20 years or however many years for something like that to happen. So there is a lot more exit options in today's world than there used to be for startups.
And it's funny, the aftermarket there is funny in a way, because if you think about it, you typically can't sell a safe, right? Or shares, options of a business that's still private. But what you're essentially selling to those third parties is the rights to them once a liquidity event takes place. In a lot of cases, it'll be something where we'll give you $100,000 now for what is the current fair market value of $150,000, but then you have to deliver that asset within 90 days of a liquidity event. But what I find funny about that is a safe itself is a promise for future equity. So they're essentially just selling a promise on a promise, right? And so there's actually other cases where that would go 3 layers deep. And at that point, the concept of how derivative it is can seem like Inception.
It's like futures.
Yeah, exactly. But yeah, that's a very good point. And actually, it's timely too. There are a lot more liquidity options now than there were even just a few years ago.
Matt, something I remember from like the whole Facebook case study, there was the part where there was a dilution event that some of the founders weren't aware of. How do you protect yourself as a potential investor on getting your shares completely diluted through future subsequent raises?
Yeah, so there are, in many cases, how do I put this? Boundaries that align interests. And what I mean by that is, and I know we don't have time to get into some complex financial modeling here, but in a lot of cases, the type of additional funding would dilute the investors and the founders somewhat equally. And the point of doing so would have to result in something dealing with the valuation that would make the value much higher. So you would end up, after an event like that, with a smaller share of a much more valuable company. Things would have to go pretty south, and there'd have to be some pretty bad decisions made for a large cash infusion to dilute people without the company's valuation increasing in a way that still makes that a value proposition, if that makes sense. Right? It's a smaller piece of a much larger cake. Dilution is real in the sense of percentage equity ownership, but in most cases, that's not going to hurt every single person that's invested. That's going to be something where it's a good decision for all, or else you typically wouldn't want to do it.
Matt, can you, because some people are going to be jumping off at the hour, can you give a place for them to connect with you?
Yeah, absolutely. My email address is matt.canning@noplex.ai. We are currently in the process of taking on a collection of beta testers for the first version of our app. Noplex is an AI-driven personal organization and productivity ecosystem for adults with ADHD, which is a absolutely huge and deeply underserved community. And if you are interested in trying it out, come let me know. Also, if you're interested in just having a conversation about anything that we talked about today, this is my world. I love it. I'll talk till you're tired of me. By all means, reach out. And also, if you're interested in learning more about the product, potential capital partnership, if you are accredited, because I am still at the end of our pre-seed round. But also, if you just want to understand more about how the deeper details of how to invest in startups, especially technology startups, we can talk about it till we're blue in the face. So
if someone comes across a startup, wants that extra guidance, they could go to you either on a coaching basis, or if it's a quick question, I'm sure you would answer for free, but they can reach out to you, Matt.
Absolutely. Yeah. Consider me a resource. If you're a friend of Dennis's, you're a friend of mine.
I appreciate it, Matt. All right, I think that's the top of that. I'll open it up. I think a few people jumped off, but if anybody has any questions, feel free to throw it in the chat or the Q&A, and then we'll make sure Matt gets to them. And then otherwise we'll call it a night. But this was a great presentation, Matt. I really do appreciate you jumping on.
My pleasure. Thank you for having me. And Ryan, nice to meet you.
Ryan, did you have any questions before you jumped on?
No, just soaking it all in. Interesting.
Man, we'll talk soon.
Thanks.
But
yeah, Anthony, I appreciate it.
I think I'll be a beta tester.
I would love you to be a beta tester.
I think they said like something about like real estate entrepreneurs are like 90. It's some incredible
ADHD.
Have ADHD.
All my teachers told me that through school, through like elementary, middle school, high school. So yeah. I just never got put on anything, and it's just figuring it out how to put that energy into different places so I can stay focused.
There you go. I'm going to reach out to you for the beta then.
There's a really good TED Talk on education and ADHD, Sir Ken Robinson, he gives, and he was talking about where it was just on the precipice of diagnosing like the kids. So I don't know if you guys know this. So my background before real estate was Social Security. And when I started in 2010, it was very difficult to get diagnosed. It was very difficult to get disability as someone that only has ADHD. So learning disabled children was like a 90% denial rate. Like you had to have Down syndrome to get it. And then in my 12-year career before I left Social Security, it started getting approved more and more, where it went from like 90% disapproval to probably like 50-50 or 40-40, depending on the situation. So what I found out was the school systems, they get a different level of funding for every kid that they have that's disabled.
Incentivized.
So the problem is the moment that incentivization kind of came about, all of a sudden they started pushing people, and some rightfully, some probably were just bad in school or didn't have a support system at home that allowed them to be good students, whatever it is. So there was a wave of disability claims, and we would literally talk to the parents, and the parents were like, the school's telling me to apply, I don't know what to do. So there was a wave. So Ken Robinson had this famous talk about this time period when a lot of these kids were again diagnosed, and it was like a mom gets called in and the kid couldn't stay still in class, and she was a girl, and she gets called into the principal's office, and the principal has the child in the waiting room and puts on music, and the mom's, yeah, I know this is frequent, the teachers complain, blah blah blah, and the principal's, no, you need to like look. And then they have a camera in the reception room, and the girl was like dancing like a full-on recital to the music, and she's completely fine, you just need to refocus her attention to something better. And then the mom ends up putting the child in dancing class, dancing school, and then she ends up becoming a Broadway professional. Like she was like the one who orchestrated like Phantom of the Opera and like Cats. So she became an uber millionaire from her talents. And it's like that whole perception of refocusing the person with ADHD. But I think it goes hand in hand with the software that you're working on.
Yeah, and hopefully I can change a lot of lives for the better. So we'll see.
Awesome. Enjoying the ride. All right, guys. I don't think there was any more questions. So happy to put this together, and I'll send over the recording later.
Thank you, guys.
Thanks a lot. Take care.
Thanks, guys. Bye.